let's differentiate between the private sector and then federally insured loans, because there are two sides to that. One is if you have a loan from a life insurance company or from a bank, they can do whatever they want. They can either foreclose on you and hold a hard line, or they can sit there and try and work with you. I think that's all borrower specific. It depends on your balance sheet. It depends on their overall exposure to you. I think it depends on the asset class and whether the future looks either, wipe out bleak or just a little muddy right now, and we'll wait for a little bit longer to see what it looks like, whether this, nobody right now is calling for a V-shaped recovery. Is it a U-shaped recovery or is it a Nike swoosh? If it's a U-shaped recovery, people might hang on a little bit longer. If it's a Nike swoosh, not so much, right? So, that's all going to come forth in the summertime as we start to see how this thing gets back up and going and how quickly people are put back to work. As it relates to federally guaranteed, there's Fannie and Freddie and HUD all have forbearance programs in place right now, mandated by the federal government on both single family as well as their multifamily lending. So for a 90-day period, if you want forbearance, you get it. So there are decision points there to companies like Walker and Dunlop about whether we're going to grant forbearance. But Fannie and Freddie and HUD all have forbearance plans in place, which allows the borrower to ask for forbearance for 90 days. And then on the other side of that, they start to pay back the payments that they were due to pay for the 3 months over a 12-month period. And so that's there. People can access it if they need to access it. And as I said previously, so far, the number of people who've accessed that is very, very low because the rent rolls have held up much better than people had expected.